Hi, everyone. I hope this message finds you doing well. I'm David Silver, CEO of Instrumental Wealth, and joining me today is Matt Harbert, Chief Investment Officer at Instrumental Wealth.
Hello, everybody.
2022 year in review. A lot of things went on last year in 2022 economically, and a lot of changes within our portfolios here at Instrumental Wealth as well. Today, we're going to unpack those not only from a broad allocation perspective and some of the changes that we made, but also talking through a number of the investments that were changed as well. So, Matt, why don't you go ahead and kick us off here and take us through some of the allocation changes that were made last year and some of the reasoning and the why behind those.
Sure. Well, let me go ahead and share some slides and we'll follow along with that. We started looking at some of the changes going on in the economic environment. And one of the big changes was the Federal Reserve. And around that time is when they started to realize that what they thought was going to happen with inflation, they were wrong. They initially had stated that they expected inflation to be transitory and would last maybe about 6 months, and then it would come back down to kind of their target rate. And obviously that didn't happen. So as we were looking at their policy, they noted that they were wrong about inflation. You would also notice that the term transitory basically was removed from any of the language in their commentary. And they started noting that reducing inflation was their top priority, and that they would be bringing up a tighter monetary policy to achieve that. And then they also mentioned that they were going to begin a quantitative tightening policy. So as you can see in the chart here, this is what they've done with the target rate. Leading into 2022, it was at 0%. And through the year, they've moved it up 425 basis point to where we're sitting now, which just to note was probably one of, if not the fastest,
Right.
We've seen a hike like that happen since it occurred just over 10 months. Secondly, we started looking at what we thought was going to happen with GDP. Our expectation is that we would start to see a slowing in the economy. Part of that was due to the high prices that would increase costs for businesses, as well as put a damper on consumer spending. And that also ended up happening as well when we looked at the March and June numbers for the fourth quarter and second quarter. Both of those were negative. So we actually ended up with 2 consecutive quarters with negative GDP growth. So we were definitely seeing that slowdown in the economy as we expected. So what were we thinking with that? Well, the first thing that comes to mind is, we had a overweight in growth, something we've had on for quite some time. We do like growth. It was an area we felt had a lot of growth potential.
And Matt, I think served our clients really well, particularly over the last decade.
That's right, it has. Really, growth has been the place to be over the last 10 years. But as the economy started slowing down, the Fed was talking about increasing interest rates. We decided we wanted to take a closer look at that positioning. So first thing we did is look at valuations across the different styles. The 2 charts I have up here, the one in the upper left is showing what they look like, what the valuations in each of those styles look like back in January of 2022. The second one to the right is the way it looked like at the end of the year. So one thing you'll notice is how expensive growth was as far as valuation. When you look at PEs and you compare the current PE to their 20-year average, large growth was trading at almost 150% of their average. So, when we kind of put those pieces together, and, a few things to point out with rising interest rates, those will typically be more negative to growth companies than they are to value companies. In addition to that, when economy slows, potentially leading to a correction in the markets, usually those that are impacted the most are those with the highest valuations.
Right.
So looking at both of those conditions, we really felt that with the environment coming up, it wasn't where we wanted to be in growth. So we actually took off that overweight to growth and went to a 50% value, 50% growth allocation in the large cap portfolio. It's worth noting also that overall, if you compared this allocation to the S&P 500, just the broad-based S&P 500, this would actually look like an underweight to growth, because the S&P actually has a higher exposure to growth than it does to value. And at that time, it was actually a fairly significant difference between the two.
Right.
So we actually not only went neutral in the position, but if you compared it against a broad market, we were actually underweight growth compared to the broad market. Once we went through changes to large cap, that was actually pretty beneficial. So if you look at how growth and value performed since we made that change, you can see that value outperformed growth by over 1,700 basis points over that period of time. So it was very beneficial for the portfolio when we made that change.
Absolutely. Absolutely. And Matt, thank you for walking through that. I think this is something that I think a lot of our clients have probably seen in their overall performance and some of that weighting. I know that there were also other areas of the portfolio that we also changed from an allocation perspective. Maybe you could walk us through some of those other broad allocation changes.
Sure. So the change we made with the growth to value in large cap, we did not make in mid and small cap. So as time went on and we started noticing the Fed did do what they said they were going to do by increasing rates, but at a much faster pace than anybody had anticipated. So we went back and decided to reevaluate mid and small cap and see if maybe we should make a change there as well. So in May, when we brought up those valuations again, you can see that in large cap, there was a significant decline in the valuations and growth from when we first looked at it in January. As I mentioned before, it was close to 150% of its average. And in May, that had dropped down to 117%. When you looked at mid, surprisingly, mid actually went up in value. So mid growth actually over that period increased its valuations and became more expensive over that time. But small also had a similar retreat in its valuations as large. But when you look at it, you can see that growth compared to value is still relatively very expensive. And given the degree that the Fed started increasing rates, we decided we would go ahead and make that same change in mid and small at this time. So in May, we did just like we did in large cap, and we went to a neutral stance of growth and value in both mid and small. So this also ended up being positive to the portfolio. So if you look at the top chart, this is in mid cap. Our growth fund in mid cap is an active fund, the BlackRock Mid Cap Growth, At that time, we trimmed out of that and moved into the core mid-cap position. And you can see based on that, that core mid-cap outperformed the BlackRock fund by over 800 basis points. Then looking at the small, still beneficial, not quite as extreme as the large and mid had done, but we still, by making that move, Calamos is our small growth fund. We trim that, move that into the small cap 600 value, and you can see the small cap value outperformed by just under 300 basis points from there to the end of the year. Lastly, the other move we made was later in the year as interest rates had started increasing. So when we started noticing this, the chart I put up here shows you various treasury rates. And you can see starting at the beginning of 22 to this point, how expensive or how much that had increased. And after many, many years of fixed income, you know, we've been pretty negative on fixed income for a long time. Low yield, the potential for, which we expected, interest rates to start rising. And then we had realized that. So interest rates rose pretty significantly. So we decided that do we want to continue with our underweight in fixed income? Or is it at a point that maybe we get some advantage there with the income that they could provide at this time? So when we looked at rates, we kind of weighed a few different things. First was, we do think, and we did think, that rates were going to continue to rise. And that would put some downward pressure on bonds. But secondly, they had risen pretty drastically already. So the yields that they were providing would actually provide some insulation to further increases in rates, at the same time adding some yield to the portfolios. And then lastly, you know, our view of the slowing economy, a potential correction, a lot of volatility. You know, bonds, the one benefit to bonds is they are less risky than other assets, particularly in that type of environment. So when we weighed the potential downward pressure from increasing rates against the added income that we could add to the portfolio and the reduced risk, we decided we would go ahead and take off that underweight that we had to fixed income. And when we did that, we pulled that from our real asset exposure. So we had also had an overweight to real assets. So we dropped our overweight to real assets and went to neutral on fixed income. And that decision had sort of mixed results. So at the time, we had real estate and gold in our real asset position. And when you compare that, when we made the move against real estate, it was very beneficial. So, you know, the fixed income has outperformed real estate by over 1,000 basis points. So that was beneficial. But when you look at it versus gold, it wasn't as beneficial. It actually, fixed income underperformed gold over that time by over 600 basis points. So sort of mixed, still a little bit better against real estate, but not quite as good against gold. So those were the tactical moves we made over 2022.
So Matt, thank you for taking us through that. I know that a lot of our clients don't get to spend as much time with you as us individually do here at Instrumental Wealth. So thank you for walking us through some of the broad allocation changes and the benefits that had for our clients. I'd like to talk a little bit further into a lot of the investment lineup changes that were also made in 2022 surrounding a lot of those decisions and the results of those decisions. So maybe walk our clients through a lot of those investment changes that we made and ultimately the result of those changes.
Sure. So leading into 2022, one of the first changes we did was in our international developed allocation. So we were invested in a fund called First Eagle. We were unhappy with the performance of First Eagle. They had underperformed for pretty consistently for some time. And so we decided to go ahead and terminate that position. Given our belief that this allocation is in an efficient style, we wanted to go more of a passive position there. So we terminated First Eagle and we moved that into a passive international developed ETF. That didn't work out quite as well for us. If you look at the international index versus First Eagle, you can see it did actually underperform by about 550 basis points over that period of time since we made that change to the end of the year. Part of the reason for that, First Eagle is actually a very conservative manager, and given some of the challenges we had in the markets, that was a period that worked out quite well for them. One of the other moves that we made is in our real asset bucket. So we initially had just real estate in our real asset position. We decided, given what was going on with inflation, that we might want to diversify that out into other areas. The top chart here shows you what happened with inflation up to the period we started talking about this. So you can see there was a huge surprise to inflation, bumping all the way up to coming close to 8%. And what we wanted to do is look at what assets would do well during that environment, because we expected inflation is going to continue for quite some time. The Fed at that time had also felt the same way, that they were backing off of that transitory stance into a more sticky stance. So we looked at different type of real assets and how they would perform with, in inflationary periods. And really those areas like commodities and gold really stood out. And if you look at real estate, which we had been into, really wasn't one of the best areas to be. So at that time, we had decided, let's go ahead and reduce our allocation to real estate, and let's add we added oil on the commodity side, and we added gold. Part of the reason for oil wasn't just inflation, but at this time we were also starting to see kind of that situation with Ukraine and Russia.
Right.
So oil kind of gave us kind of two reasons. One was it performs well generally in periods of high inflation, but secondly, we didn't know what was going to happen globally with the war in Ukraine and its impact on oil and energy. So we felt that would have the additional benefit of hedging some of those potential problems that would come up. So those moves actually worked pretty well, particularly oil. So when we added oil, we actually only kept that for a few months. So we added that in March, and by the time June came along, oil had substantially appreciated. And at that point, we looked at oil versus kind of where it had been historically, and it was up at one of the highest it's been. So we decided to remove that position at that time and go ahead and take the return that we got from it. And that worked out quite well. So if you look at the top United States oil, that was the fund that we were in. The trade we made earned just a little over 10%. And when you look at all of the other asset classes over that same period, they were all not only negative, but most of them were pretty significantly negative. So relative to all the other asset classes, that was pretty beneficial. on top of that, oil, we may not have gotten the exact high, but we were about a week off of that high. Has following that has started to pull back ever since. So that actually timed out pretty well for us.
Comparing to the other benchmarks from where we pulled from, as we saw, they were all negative.
That's right. That's right. So looking at gold was a little bit more mixed. So when we look at gold, if you look at it against the real estate fund that we had, that we diversified away from, that was very positive. So gold actually outperformed that REIT fund that we had by over 1,000 basis points from there to the end of the year. However, since we did, as you mentioned, pulled it from other asset classes, that was where it was a little mixed. You can see the bolded part, kind of about 2/3 of the way down. That's the gold trust that we purchased. And when you compare that against the other benchmarks, it's better than most of those that were very extreme. Particularly, you'll see a lot of those are actually the growth that was correcting. But some of the other areas actually didn't do quite as well. So oil was very positive for us. Gold was positive for us against the real estate that we diversified out, mixed against many of the other asset classes that we pulled from. After that, we also decided to make a change in our emerging market exposures. So we were passive in emerging markets. We had kind of a hybrid, active, passive. American funds was our core fund, but we also had a pretty significant allocation to a passive MSCI emerging markets fund. Given what we were seeing in the geopolitical environment and many of the challenges we saw out there, on top of the fact that this is a very inefficient asset class, we decided we wanted to move away from that passive position, make it active, put that with a manager that we felt confident in and would be able to navigate some of those markets. And that worked out pretty well for us as well. As you can see, the American funds over that time period outperformed that passive fund by 365 basis points. So lastly, we made a change in our fixed income positions. So again, as we talked, interest rates were rising. That rising interest rate can put downward pressure on the price of bonds. We really wanted to hedge that out a little bit. So particularly since we were talking about moving into a higher allocation to fixed income. So what we decided to do was move out of MetWest, or at least trim that position pretty significantly, and take that and put it into a target maturity bond fund. And to explain that a little bit, all that means is that works a little bit more like an actual bond. There is a maturity date on that, and the fund invests in bonds internally that all mature around that maturity date. So instead of having to sell out of the fund and get market prices, what happens is the fund holds all those positions, they let them mature, and then the money would come back to us at the end. So it does a really good job at hedging the increase in rates. And looking at this, you can see since when we put that on in June to the end of the year, it actually was also beneficial to the portfolio, outperforming MetWest just under 400 basis points. Now I'll note that while we look at this number here, the intent is not to sell it. So this is what it would look like if we wanted to sell at that time, but our intent is actually to hold that until it matures, in which case we should get the actual yield that we had expected. At this time, it was somewhere around 3.25% to 3.5%. So that's what we expect to get out of that position from when we put it on. So those are the investment moves that we made over 2022.
Well, thank you for taking us through that, Matt. And ultimately, I know I can speak for you here as well as all of the members of the investment committee that worked so diligently last year to work through a lot of the rapid changes that were taking place, not only with the economy, but the Fed's moves. And for the most part, almost all of those trades worked out to our clients' advantage. And so thank you to the investment committee, and thank you for all of those moves that were made last year, as they all, for the most part, worked out very positively for our clients' portfolios. So, Matt, as we conclude this recording, I know on a lot of people's minds here are what's going to go on in 2023. As we're recording this, we just got the first CPI read, where I should say the last CPI read of 2022 for December. And of course, it looks like inflation is further evidence that inflation has reached its peak, still far too high for the Fed's liking, and some other data that's starting to roll in here in early January. Maybe spend a couple of minutes talking about 2023 and some of the moves that we're going to be making here, really any day now in early January as we're doing this recording.
Sure. So first, what we expect to go on in the economy over 2023, I think much of that is just a carryover from 2022. In some areas, moderating a little bit. But we do expect, as you mentioned, inflation came out. It is still high. We mentioned a couple of months ago that we felt we were at a peak, and I think we still believe that, and the number is pulling back a little bit. So I think we've reached our peak, but I do think that it's going to continue to remain elevated, at least through most of the year, if not all the way to the end of the year. That being said, that will continue to keep the Fed in a tight policy. They have mentioned that they have opened the door to kind of moderating that a little bit. So while I do expect them to continue raising rates, I don't expect them to do it at the speed that they did in early 2022. They've already lowered. The last rate hike went down from a 75 basis point hike to a 50 basis point hike. The next one coming up, I would expect would be, maybe 25 basis points to 50 basis points. And they've said as much that they did expect to maybe moderate that a little bit. But they've also mentioned that they expect it to remain, the actual rates to remain higher longer. So while we may not see as much of the quick increase in rates, I think we can expect them to keep those rates higher for longer than maybe we had expected several months ago. I think as far as how that impacts the economy, I think we probably are likely, I think it's probable that we will see some sort of recession over 2023. It's probably not going to be an extreme recession like we saw in the financial crisis. I do expect that to be a more moderate recession, but we do feel it's probable that we would go into at least a moderate recession over 2023. So that being said, what changes are we planning on making in the portfolio? So there are a couple that we are looking at making that will probably occur sometime within the next month. And one of those is actually a strategic change to our portfolios, and that is an addition to an alternative asset bucket. One of the things we like about that, first, it's an exposure that we don't have currently that typically behaves very different than public equities as well as fixed income. So it gives us something that has a little less correlation to kind of your traditional 60-40 equity fixed. And in that bucket, we're looking at adding some private equity exposure, some private debt exposure, and some private real estate exposure. So all of those we expect that will help a little bit in an environment that's very volatile, and which, given some of the liquidity restrictions they have on there, it does prevent a lot of that fickleness from people moving out and driving prices down. So it has a tendency to allow to level some of that volatility out. Secondly, it gives us exposures in areas that might have, on the fixed side, higher income opportunities, and then the equity side, really some equity, some firm potential that some exciting businesses that have higher growth potential in there. On top of that, one of the things, given the potential to move into a recession, we also wanted to add some quality to the portfolio. So we are looking at adding some funds that we feel have, based on their strategy, will be adding higher quality businesses in the portfolio that will have high cash flow yields. So typically, if the economy starts to slow, if that leads to a further decline in the markets, people feel more comfortable with businesses that have stronger cash flows, that can manage that debt levels that they have, lower leverage, that sort of thing. So the fund we're looking at is really trying to zero in on funds that will have stronger cash flows, and typically those that can take care of their debt as well. Wonderful. So that's the immediate changes we're looking at for 2023.
Yeah, and certainly probably more to come depending on what actually transpires this year. So Matt, thank you for sharing your insights here for 2023, as well as doing the year in review for 2022. I know our clients will find this very, very beneficial. And for all of those watching this, I know that there was probably some questions that you might have. Be on the lookout for your advisor to be reaching out to you to discuss not only this recording and sort of the 2022 recap and what's going to take place in 2023, but also be able to answer questions that you might have from this recording or anything else for that matter. So Matt, thank you for sharing your time and wisdom with us as always. And to everybody watching it, thanks for tuning in, and to be continued. Thanks everybody, and we hope 2023 is a fantastic year for you, both personally, professionally, and of course, financially. Thanks everybody, have a great year.